This is the MBK Beat with Mark Kashevsky from MBK and Associates, Inc. Your place for finding all you need to know about life insurance and how you can get more of your money. Recorded live here in Buffalo, New York, it's time for the MBK Beat with Mark Kashevsky. Hello there and welcome back. It's the MBK Beat with Mark Kashevsky. How are we doing today, Mark?
Hey, we're doing great. We are celebrating the Buffalo Bills thumping of the Kansas City Chiefs.
That's right.
Who are now 2-3.
It is a beautiful time in Western New York. October 14th, beautiful sunny day. As you know, it's the MBK Beat. We're in the second season. This is the case example series. So today will be the fourth case example. And today we're going to be doing premium finance intelligent leverage. But to tell you about that is going to be the expert here, Mark Kashevsky. So I will turn it over to you, Mark, so you can present to the viewer the premium finance intelligent leverage package.
So let me start out, Jeremy, by telling who should be listening to this podcast in this case study. If you're a successful professional business owner with significant positive cash flow and tax issues, and or you're a high net worth person or a real estate developer who has significant needs for capital, and you have significant life insurance needs as well for key man, bank coverage, estate situations, you should be listening to this podcast.
Excellent.
So what is premium finance? I refer to it as intelligent leverage. And as I go through, I'm going to go through three examples. You're going to see why this is not only intelligent but significant for the right people. The first thing is, what is premium financing? It's a method for paying for life insurance premiums using loan funds instead of current income or proceeds from the sale of assets. The premium payments are essentially reduced to the loan interest on the loan to pay for those premiums. How does it work? Well, an individual applies for life insurance and arranges for a premium loan from a third-party lending institution. There used to be a lot of commercial banks that did this, but the market really is private banking. Institutions are doing this. People like Goldman Sachs, companies like Gracie Point. There's a whole host of people that do this, and this is all they do. And there's a lot of money in this space for this strategy. Billions of dollars, literally. Once the life insurance is approved and the loan is secured, there may be some additional collateral needed up front because initially the cash buildup in the policy, and we'll see this in the examples, isn't sufficient to cover the loan requirements. So some initial collateral in the early years is required, or a letter of credit. That's basically how it works. As I mentioned, if you need a lot of life insurance, and you've got a positive balance sheet and significant cash flow, this is a great strategy. If you're in an estate planning situation, gift taxes become an issue in terms of premium payments into a trust. This can eliminate that problem, and it's basically you're reducing the annual outlay for insurance. So it's a very, very intriguing strategy.
Perfect. And as we walk through the case example, we will get to look at just example. We have three examples today?
Yeah, we do. So I've already gone over the profile, but I do want to spend a minute on, there are different applications here for using this. Actually, I bumped in. I was working with a CPA firm last night, and they have a client where they want to set up a SERP for two of the owners. We're going to show them a leveraged SERP. I've got a case right now I'm headed to after this meeting where two brothers have a significant buy-sell situation, very successful business. We're going to show a leveraged buy-sell. And the basic one is, for liquidity or income replacement. So we're going to have three examples we're going to go over. All right?
Perfect. And these are all for essentially anyone between 25 and 80 as long as they qualify at a, where are we looking in terms of?
The sweet spot is really of age 40 to 65. Okay, that's where you're going to get the biggest bang for your buck on this. I have done one of these with a younger person in a very wealthy situation, and I've done some with older people, really for estate liquidity, to minimize the out-of-pocket cost and to minimize the gift act issues. But the home run is really between people between 40 and roughly 60.
Perfect.
Now, we work with a third party that helps us structure these SCA, Succession Capital Alliance. They've been doing this for 30 years. They have offices in Newport Beach and New York City, and this is all they do. And they deal with a variety of companies and a variety of lenders. And they know how the game is played and how to manage it. Because at the end of the day, it's a great concept, and you can get the insurance in place and the loan in place, but you better know how to structure the deal, how to structure the loan, and manage the whole process. Because this is a long-term process, and that's what they do. I'm going to go right to a case example here. This is kind of my baseline example here. This could be for, I'm a successful person, I need life insurance for a loan, for key man, for estate liquidity. And how does this compare to paying cash versus intelligent leverage or premium financing? Well, let's just say we need $10 million of life insurance, and we're going to pay it out of pocket. Well, we're going to pay for a permanent policy that we would sell them $117,000 a year for this person who's age 50, okay? And over the course of 30 years, this person is going to pay $3.5 million. It'll build up some significant value, almost $5 million in cash, and there's a 10% $10 million death benefit. Well, how does that compare to premium finance or leverage? And this is why real estate developers don't pay cash for real estate. This is why they leverage, because for less money they can get more out of it. And that's exactly what's going to happen here. What we're going to do is go to a third-party lender, and we're going to front-load the premiums over 5 years. We're going to borrow $3.5 million over 5 years to fund this policy. And there's no more money going into it. And the loan at 2%, now LARPR right now is less than 0.5%. And actually, all the premium finance cases I have, the annual loan rate is actually below 2% right now. Now, this loan rate could go up, and we'll show examples what happens if it goes up. And it still works, number one. Number two, we will also typically include what's known as a swap in these loans, so that if we feel that interest rates are headed the wrong way, for a fee, the client can pay a swap and lock in a rate so that it won't go up anymore. So we can protect the downside on this side of the equation. All right? So what is the client going to pay? Well, the first year is going to be $16,000, but as the loan goes up, the interest is going to grow to $72,000. And over the course of 20 years, this client is going to pay $1.3 million in interest charges. By the way, had he paid the premium, it would have been $2.3 million. So we've already saved him or her $1 million. But because the policy has grown, the value has grown to $6.7 million, we have enough money in here to pay back the loan. Okay? And where are we doing that here? Paying off the loan in the year 21. This $3.5 million is gone in year 21. And this policy will maintain itself forever. And at 30 years, what are the results? Well, we already saw $3.5 million in premiums here to get $4 million in cash for $10 million. Here we've paid $1.3 million. That's over $2 million less, $2.1 million less, okay? And the cash value in 30 years is $5.7 million versus $4.9 million. And by the way, you've saved $2 million. And if you allocate that, if you put that in an account at 4%, you're almost $4 million ahead. Which plan looks better to you, Jeremy?
I would have to say the one that A, saves first, because that obviously, firstly, as I can see the demonstration, saves you the money up front, but then also you would be then gaining more cash value than the original as well.
Very good. You looked like you had a good night's sleep last night. You woke up on the right side of the bed. But
we're learning here.
This is the definition of intelligent leverage, all right, if it's done properly. Now, the other two other examples I just want to go over quickly is I have a case like this. I opened up last night with a CPA firm and two executives. It's a leveraged executive bonus. They want to provide a supplemental retirement plan for two executives. And we haven't done the numbers for them, but this is another case. They were going to spend $25,000 a year in this case, okay? And this gentleman is 45 years old. And that means they were going to put the money in for 10 years and pay $250,000. We're going to do leverage, and we're going to borrow $200,000 a year for 5 years, borrow $1 million, and using the same loan rate, they're going to pay the interest. The company is going to pay the interest on this loan. So they're actually over 10 years. 10 years, they're going to pay a little less. The loan's going to go a little longer, but they're going to end up paying about the same here, $263,000. They would have paid over here $250,000, excuse me. But in this case, we're able to pay the loan off in year 16. And in this case, if we get to, if we run this out 30 years, this contract has $790,000 in cash. This one has almost $1.2 million. And what we're going to end up doing here is providing some income. And if we did it at age 65, I don't have those numbers on the sheet here, but this surrender value would generate about $32,000 a year. This one will generate about $50,000 a year at 65. So for about the same amount of money, we're getting them bigger bang for their buck.
And that would be at 65.
Right, at 65.
And now, how does the first example, in terms of just the user or the subject client, what is the difference again between the first example and the second example?
Well, the first one is just an individual. Am I going to pay for life insurance out of my pocket, or am I going to pay for it using premium finance?
Got it.
The second one is I've got a key employee I want to do a supplemental retirement plan on, and I'm willing to pay $25,000 a year to fund it. Would this one do a better job? Okay.
Got it.
All right. And my last example, and this is a case I'm actually working on right now with two brothers, very successful firm, and they have a buy-sell in place right now for $10 million each. So there's two of these going on. This is on one of the brothers. So, and they're both 45. I'm just going to show one of them here, obviously. But they need $10 million of life insurance. Now, right now, they're buying term insurance, okay? Paying cash on a term policy. And they're putting a lot of money away personally into investments.
On their own?
On their own. They're maxing their 401k. They can't do a Roth. And this is one of the reasons I'm showing this to them. And they've got brokerage accounts. So I said, guys, if I could show you a way to turn your current buy-sell into a Roth on steroids, would you be interested? Well, they said, show me, as they say in Missouri. So this is what they're doing right now. They're buying the term insurance. They're paying roughly $18,000 a year. And it's multiple policies. But ultimately, all this term insurance is going to, 20 years, they're going to pay about $370,000 for the term insurance. And then at the end of 20 years, the insurance is gone. It's done. And I said,
because it's term?
Because it's term. And I said, well, let's compare this to what if we were to do a leveraged $10 million on each of you. And here's what the interest cost would be on the loan. So you would pay in 10 years $530,000 versus $186,000. So let's invest the difference over 10 years. Over 20 years, the net outlay is $973,000 in interest versus the term premium of $373,000. So we invest the difference of $600,000 over the time period with the correct numbers, and we're using a growth rate of roughly over 5%, which is the same rate we're using on the insurance policy, apples to apples. And they're in a pretty high tax bracket. So, and then we're going to start taking income when they retire. Now, on the premium, and by the way, the loan on this policy is also paid off, all right? We've borrowed $3 million here, and in year 18, at a 5% cash value buildup, we've paid off the loan in year 18. So when they get to 65, there's no loan on the policy, and there's $2.7 million in the cash value, by the way, versus $870,000 in the buy term and invest the difference account, using the same interest rate. So we can start generating $260,000 a year of tax-free income for 20 years. For 20 years, from year 20 to year 40, 65 to 85. Here, they're going to run out of money in 3 years. Which one do you like better, Jeremy?
Yeah, obviously that factor. Now, you mentioned that would be a term, kind of almost like a transitioning from what they've already done with the term, but I feel like one of the biggest stark things that you mentioned was that term would run out in 20 years versus in, say, 20 years getting $260,000 cash, tax-efficient, tax-free a month.
Right. Every product we sell, because it's tied to an insurance-related funding arrangement, creates tax-free income.
And that's the underlying theme here, it seems, is that's what you do, is get it there.
Tax-free income is huge, and I don't know what's going to happen with this pending tax legislation and this, $5 trillion spending bill. I have no idea what's going to happen, but, and we've got inflation. It's not around the corner. It's here. Mm-hmm. We have the Fed printing money. I mean, a year ago there was, I think it was $2 trillion. It was between $2 and $3 trillion in our banking system in the United States, circulating in our country. This March or April there was $13 trillion.
Say that one more time. What was the first to the second?
In March of 2020, there was $3 trillion of cash in the banking system. I believe the number is $3 trillion. That's how much money was circulating around the whole country.
And now it's 13?
13 trillion. The government, with PPP and everything associated with that, they spent $6 trillion and they didn't have it, so it was printed. And with quantitative easing, the Fed spent another $6 trillion they injected into the system during COVID. So we've had another 13 trillion. I think they interjected about $4 trillion. So between the Fed and Congress, they've added $10 trillion to the banking system. So if you want to know why eggs are up, gas is up, steel's up. I just met with a client who said my price of steel's up 40%. Wages are way up, but wages aren't keeping up with inflation. And so, and someone's got to pay for all this spending. Taxes are going to go up at some level. So when you can talk about tax-free income, and I've mentioned this in my prior podcast as well, one of the advantages of the product we're selling is there's going to be a lot of volatility going forward in my mind. You're going to have wide swings in the market. And I just had a client that was in a contract, had over $1 million in his policy. When the market went down 60%, he lost zero. But he was in an uncapped index, which was one of the options, and he also bought a secondary option. He doubled down. And this year, when he got his statement, his cash value went up $1.8 million. His cash in his life insurance policy went from $1.2 to $3 million in 1 year. So this is what we're promoting. It's a tremendous product, but these are also, and I can't show any of that stuff obviously on these strategies. So I think there's a tremendous amount of value in the underlying product we're funding, and I think we've got great value in strategies in terms of adding value to people's situation.
Awesome. Excellent. Is there anything else that you wanted to add for the viewer today?
If you have a significant need for life insurance, you've got estate planning needs, or you're looking to create some more tax-free income, call us.
Thank you, Mark. And on to Monday Night Football, down to Tennessee this week. Who you got? What's the score prediction?
I think it's going to be. I think the Bills are going to win something like 31-17. I mean, the defense is just that good, and I think we'll stop the run. And I think they're just are they going to win every game? No, but I think they're primed to win this one and take a week off.
That's true. They do have the bye after that. Well, thank you very much for listening, folks. As always, my name is Jeremy. This is Mark the Expert, Mark Kashevsky. Thank you for listening, and we'll see you on the next episode.
Go Bills.